Hi friends, welcome to my YouTube channel FinWing, Flying with a Wing of Finance. Today we are today we are talking about the topic all about mutual funds. So, before proceeding to understand what are mutual funds, first of all, we need to understand what is market capitalization. So, market capitalization. What do you mean by market capitalization? Market capitalization is nothing but it is the market value of a company. And how it is calculated? It is calculated by multiplying number of outstanding shares of a company multiplied by market price of shares. So this is known as market capitalization. For example, you can see here that assuming number of outstanding shares is 1 lakh and market price of a share is $500. So the total market capitalization of a company is around 5 crore dollars. So this is known as market capitalization. Basically, it is a market value of a company. Now, according to SEBI, we have some definitions regarding the large cap companies, mid cap companies, and small cap companies. What are large cap companies? What are mid cap and what are small cap? So these are given by SEBI, the Securities Exchange Board of India, which is a regulator of stock markets. So now, large cap companies are those companies which are ranked from first to 100 company in Indian exchanges in terms of market capitalization. That is, they are that is the companies have been ranked from first to 100 in terms of market capitalization, which is one of the largest market capitalization company would be first company, then second company, then third, and so on from first to 100th ranked of the company. The market capitalization of a company, that company would be categorized as large cap company. Similarly, mid cap companies are those companies which will be ranked from 101 to 250th in terms of market capitalization. And what are the small cap companies? Small cap companies are those companies which will be ranked from 251st and so on in terms of market capitalization. So we are here seeing that these companies, that is large cap companies, mid cap companies, and small cap companies, these are categorized according to the market capitalization of the company. And as we have seen earlier, that market capitalization is what? It is the market value of a company. So now we are on the mutual funds. What are mutual funds? Basically, mutual fund is a company that pools money from the investors and invests these money in various types of securities. Basically, what it is it is pooling the savings of a number of people which are participating in the fund and investing these money in various types of securities according to the fund scheme, according to the scheme that has been chosen by the investors. Now, one of the most important benefit of mutual funds is professional management. Now, what do you mean by professional management? Now, when we say professional management, it is known that these mutual funds are being managed by a professional expertise, by a professional who has an expertise in the investment field, who has an expertise in the investment field, and therefore it therefore your money is safe in the hands of the fund manager. And and one of the most benefit can also be a time saving, because nowadays so many investors do not have a time that they will be reading the stock market charts, or they will be analyzing the markets. So here is a solution. What is the solution is that here is the professionals who are engaged in these types of investment. And it also has the benefits of investing in mutual funds with a small amount as low as rupees 500 to 1000. Now, what does it mean this? What would be the impact of this? The impact of this is that it is giving access to the small investors and giving an opportunity to the small investors to become a participant in the capital market. And what are the benefit? And one of the most important benefit is also cost averaging when investing in mutual funds through SIPs. Now, what do you mean by SIPs? SIPs means a systematic investment plan. What we do in the systematic investment plan is that we the investor invest a fixed amount of money. Investor invest a fixed amount of money every month. So every month they will be contributing a fixed amount of money, say as low as rupees 500 or 1000 or 10,000 rupees per month. And then these money would be invested. But now, how the cost averaging would come? Cost averaging would come Every month the investor would invest, and what would happen every month, the stock market would go up and down, and up and down. And just assume that in first month the market goes down, so the units would be purchased at a lower price and more units would be allotted to the investor. And in the second month it has gone up, then it again they will be allocated less units for a higher number of for a higher price, then again down. So what is being what is being taken over here, here there is a cost averaging. The cost is being averaged because you are participating in the ups and downs of the market. What the investor is doing, investors is participating in the up and down of the markets. So therefore there will be a cost averaging whenever the investment is done in mutual funds through SIPs. Okay, now we come to the chapter what are types of mutual fund schemes. Now there are two types of mutual fund schemes, that is open-ended schemes and closed-ended schemes. Now what are these open-ended schemes and closed-ended schemes? Now open-ended schemes are those mutual fund schemes which are open for subscription and repurchase on a continuous basis on all business days at the current NAV. Now what is the NAV? NAV is the net asset value. The current NAV is the net asset value, that is market value of assets minus liabilities divided by number of units, that comes to the NAV, that is net asset value. So what we are saying over here is that the scheme is open ended means here the fund would allow the investors to enter and exit the market anytime. There is no time restriction. Investors can come at any time and can purchase the units and can also exit the units by selling or redeeming the units at any time. There is no time restriction. But whereas in the case of a closed-ended scheme, these schemes have a fixed maturity date. That is, these units are issued at the time of initial offer and redeemed only on maturity. And these units are redeemed only on maturity. Now the units of closed-ended schemes, now these units are because units as these scheme is closed-ended, so therefore they are mandatorily required to list this fund in the stock exchange, so that investors can be provided with an exit route before maturity, and they can sell these units in the stock exchange. So these closed-ended schemes are required to be listed on the stock exchange. Now we will be classifying these mutual fund schemes by the portfolio management. Now, now, now these schemes has been classified according to the management style of the fund manager. What is the management style of the fund manager? Now these are two types of fund, that is active funds and passive funds. Now what is the active funds and passive funds? Now active funds are those funds in which the fund manager is actively engaged in managing the fund. The fund manager is active in deciding when to buy, hold, or sell the underlying securities and in the stock selection. What happens that they have a discretion in selecting the stocks, which type of stocks they want to buy or hold or sell it, because here the fund manager is actively engaged in the managing the fund. Whereas in a passive fund, here the style of a manager is of a passive role. Here there is a fund manager has a passive role in stock selection and in buying, selling, and holding decisions. Now what now how then these funds are managed if there is a passive role? Here the decisions are driven by the benchmark index, and the fund manager merely needs to replicate this index with a minimal tracking error. Here in now minimum with a minimum tracking error with a minimum tracking error they need to replicate the index fund, the benchmark index which has been benchmarked. Now what happens here, the one of the example of passive fund is index fund. Now what are these index funds? Index funds are linked to a specific index. For instance, there is a Sensex. Sensex is one of the index which comprises of 30 stocks. So what would happen is that if there is a fund manager and there is a fund scheme of a passive scheme, all the all the and he will be investing the funds of the investors. He will be investing the funds of the investor in same proportion as it is in the index sensex 30. In the same percentage he will be required to invest in various stocks as it is in the sensex 30 stocks constituents कर रहे हैं constituents. Okay. Then comes category of mutual fund schemes. Now there are multiple categories of mutual funds. There are many schemes. There are plethora of mutual fund schemes of the category. One of the category of the mutual fund is multi-cap funds. Now what are multi-cap funds? Multi-cap funds are those funds which are required to hold at least 75% of their assets in equity and equity related instruments, and the portfolio must allocate at least 25% of its assets to large cap stocks, 25% to mid cap stocks, and another 25% to small cap stocks. What happens is there that here at least 75% of the assets needs to be invested in equity and equity related instruments, and there is a mandatory from SEBI that at least 25% of the assets has to be invested in large cap stocks, and another 25% has to be invested in mid cap stocks, and another 25% has to be in small cap stocks. Whereas another fund is known as flexi cap fund. Now as the name suggests, flexi, it gives the flexibility to the fund manager in allocating the funds between the large cap funds, mid cap funds, and small cap stocks. Here what happens is that 65% of the assets are allocated to equity and equity related instruments. If a fund manager feels a need to reduce the exposure to small caps during economic uncertainty, he or she can reduce allocation. He or she can reduce allocation to zero and increase the allocation to large caps or mid caps. But a multi-cap fund can't manage its portfolio in such a dynamic manner. So you can see here what's the difference between a multi-cap fund and a flexi-cap funds. In multi-cap funds, what happens is that here there is a limitation that at least 25% of its assets has to be invested in large cap stock, and 25% to mid cap stock, and 25% to small cap stock. But here in a flexi-cap fund, there is a flexibility given to a fund manager. Here 65% of the assets are allocated to equity and equity instruments, and here as I have mentioned earlier, that if a fund manager feels a need that he was reduced exposure to small caps due to economic uncertainty, he or she can reduce it to zero and increase the allocation to large cap or mid cap. But this this privilege is not given in case of a multi cap fund. Then comes large cap funds. Now these are those funds where minimum investments in equity and equity instruments are done in large cap companies, and a minimum is at least there 80% of the total assets. Similarly, there is a large cap and mid cap fund. Now these are those funds where at least 35% of the investments are done in large cap stocks, and at least 35% of the investment is done in mid cap stocks. Then comes your mid cap funds. These are those funds where at least 65% of the investments are done in mid cap companies. Then comes small cap funds. These are the funds which invest at least 65% of the total assets in small cap companies. Then comes dividend yield fund. These are the funds which predominantly invest in dividend yielding stocks with at least minimum investments in equity at 65% of total assets. Now these funds, what happens is that these funds predominantly invest in dividend yielding stocks. Now these dividend yielding stocks may be for PSU stocks, because majorly there are some PSU stocks which are uh, which are dividend paying stocks. So here the fund manager will allocate the investments into PSU stocks, predominantly in PSU stocks, but not always, but not whole of the investments PSU. It might also be a private company also. Then comes value funds. Now value funds, what are these funds? Now these are the funds which follows a value investment strategy, having a minimum investments in equity and equity related instruments of 65% of total assets. Now what are the value investment strategy here? Value investment strategy is the strategy of investing in stocks of those companies which have been identified as an undervalued company based on fundamental analysis. And here, as we know, that value investing style has come from a come from a legend investor, that is Warren Buffett, uh, who has been a legend investor and has introduced a value investing strategy. So that's why here the strategy of investing in stocks is as companies which are undervalued based on fundamental analysis. Then comes contra fund. Now, what are the funds of what are contra funds? Now, these are the funds which follows a contrarian investment strategy and requires a minimum investments of in equity and equity-linked instruments of 65% of total assets. Contra funds. Now, what are contra funds? Now, these are the funds which follows a contrarian investment strategy and requires a minimum investments in equity and equity-related instruments of at least 65% of the total assets. Now, what is this contrarian investment strategy? It is investing against the existing market trends and purchases stocks which are not performing well currently. The fund manager here takes the contrarian view of the stocks when it is shunned by the investors. Here, here the fund manager is being contrarian of the view when the investors are not purchasing the stocks, then these are the fund managers who will come forward and purchase those stocks which are not performing well currently. So here the fund manager is taking a contrarian view. Now comes sectoral or thematic funds. Now, what are these sectoral thematic funds? These are the funds which invest in a particular sector or a particular theme. It invests 80% of the total assets in equity and equity related instruments in the sector. These sectors might be an IT sector, banking sector, oil sector, or an automotive sector, or infrastructure sector. So these are the funds which would invest in a particular sector. These are known as sectoral funds. Then comes ELSS. Now, what do you mean by ELSS? ELSS stands for Equity Linked Savings Scheme. This is an open ended equity linked savings schemes with a lock in period of 3 years, and here the investor can claim a tax benefit of investing it under Section 80C. Here, at least 80% of the investments needs to be made in equity and equity related instruments in accordance with the Equity Linked Savings Scheme 2005 notified by Ministry of Finance. So here is the end of here so here is the end of all about mutual funds part 1. I would come again and describe you and give you a knowledge about and share you a knowledge about the debt funds scheme in the next part. So invest so friends, please like and subscribe my channel for the remaining videos which is yet to be uploaded. If you like this video, please like and please give your comments. If Please provide your feedback and comments to it. Thank you very much.